European banks are back in the spotlight, and this earnings season could reveal just how strong the sector really is. After several major U.S. banks reported impressive second-quarter results, investors are now waiting to see if Europe's biggest lenders can deliver similar momentum. Analysts expect profits to rise, helped by steady loan growth, higher interest rates, and stronger trading activity. But there's a bigger question beneath the headlines. Can Europe's banking sector continue its comeback after years of rebuilding? Or will economic uncertainty and geopolitical risks begin to slow that progress? In this video, we'll break down what's driving expectations, which banks investors are watching most closely, and why these earnings could matter far beyond the banking industry. Over the next 2 weeks, many of Europe's largest financial institutions will release their second-quarter earnings, offering one of the clearest snapshots yet of the region's economic health. The reporting season begins with Italy's UniCredit and Spain's Santander, followed by BNP Paribas in France. Next week, attention shifts to Barclays, Deutsche Bank, UBS, and BBVA. These reports arrive shortly after strong earnings from several Wall Street banks, setting the stage for inevitable comparisons between Europe and the United States. While investors will be looking at profit figures, they'll also be listening carefully for what bank executives say about lending, interest rates, market conditions, and the outlook for the months ahead. According to analysts at Goldman Sachs, European banks are expected to post an average 11% year-over-year increase in second-quarter pre-tax profit. Several factors are driving that forecast. Loan volumes have continued to grow, allowing banks to generate more income from lending to households and businesses. Interest rates have also remained higher than many markets expected, particularly since the start of the Iran conflict. That has helped banks maintain healthy lending margins, the difference between the interest they earn on loans and what they pay to depositors. Banks are also benefiting from higher non-interest income, including fees from financial services and investment-related businesses. At the same time, many institutions have continued cutting costs and improving efficiency. Analysts say technologies like artificial intelligence are increasingly helping banks automate routine operations, streamline workflows, and improve productivity. Combined with relatively stable loan quality, those trends are expected to support another solid quarter for the sector. The current optimism marks a dramatic turnaround for Europe's banking industry. For years after the global financial crisis, many European lenders struggled with low profitability, extremely low, and in some cases negative. Interest rates made it difficult for banks to earn healthy returns from traditional lending. That changed as interest rates moved higher over the past several years. Higher borrowing costs boosted lending income, while credit losses remained more manageable than many analysts had expected. As a result, European banks have now enjoyed more than 2 years of improving profitability. That recovery has also been reflected in the stock market. The Euro Stoxx Banks Index has doubled over the past 2 years, reaching its highest level since before the 2007 to 2008 global financial crisis. Today, bank stocks have become one of the strongest performing sectors in Europe, a remarkable shift from where the industry stood just a few years ago. This earnings season features many of Europe's biggest financial institutions, each providing insight into different parts of the regional economy. UniCredit is drawing particular attention as it moves closer to taking control of Germany's Commerzbank, a deal that could become one of Europe's most significant banking mergers in decades. Meanwhile, investors will closely follow results from Santander, BNP Paribas, Barclays, Deutsche Bank, UBS, and BBVA. Together, these banks operate across retail banking, corporate lending, wealth management, trading, and investment banking. Their earnings won't just reveal how individual companies performed, they'll also offer valuable clues about business activity, consumer borrowing, and the overall direction of Europe's economy. And while expectations are generally positive, there's another important factor that could shape market reactions. That's where the outlook becomes just as important as the earnings themselves. When these earnings reports are released, the headline profit numbers will grab attention, but they may not be what moves the market the most. Investors will be listening closely to what bank executives say about the months ahead. One key issue is whether geopolitical tensions, particularly following the Iran conflict, are beginning to affect business confidence across Europe. So far, higher interest rates have continued supporting bank earnings. But if uncertainty causes companies to delay investments or consumers to borrow less, that could eventually slow future growth. Another closely watched area is credit quality. Banks have largely avoided a sharp increase in bad loans, helping keep profits strong. However, if economic conditions weaken, lenders may need to set aside more money to cover potential loan losses. That would reduce earnings even if overall business activity remains stable. These forward-looking comments could have just as much impact on investor sentiment as the quarterly results themselves. Another major driver of this quarter's results is expected to be stronger performance from trading and investment banking. The market volatility triggered by the Iran conflict led to heavier trading across stocks, bonds, currencies, and commodities. For banks with large trading operations, that increased activity can translate into higher revenue. Investment banking has also benefited from a pickup in corporate deal-making. Large mergers and acquisitions, along with new initial public offerings, have generated additional advisory and underwriting fees, giving banks another source of earnings beyond traditional lending. This diversification is important because it reduces reliance on interest income alone. Instead of depending solely on higher borrowing costs, banks are generating revenue from multiple parts of their business. That combination has helped strengthen expectations for another profitable quarter. Even with Europe's improving performance, U.S. banks continue to set the pace in global investment banking. America's larger economy and deeper capital markets give Wall Street firms a significant advantage when it comes to mergers, stock offerings, and trading activity. That difference is expected to show up once again this earnings season. According to Morgan Stanley, UBS is forecast to deliver around 21% growth in second quarter investment banking revenue, reflecting its strength in equities trading. By comparison, BNP Paribas is expected to post about 7% growth, while Société Générale is forecast to see roughly 2% growth. Those numbers are respectable, but they remain well below the gains reported by several major U.S. banks, where comparable businesses recently recorded revenue increases of more than 30%. For investors, the comparison highlights both the progress European banks have made and the competitive gap that still exists. Looking beyond this quarter, analysts see both encouraging trends and potential challenges for Europe's banking sector. Morgan Stanley has identified Deutsche Bank as one of its preferred picks, describing it as the cheapest bank in its coverage based on valuation. At the same time, the firm remains more cautious on UBS, citing uncertainty surrounding proposed Swiss banking regulations that could affect future capital requirements. Elsewhere, French banks will be under close scrutiny after reporting relatively soft trading results earlier this year. Investors will want to see whether market activity improved enough during the second quarter to drive a stronger performance. For banks in Spain and Portugal, analysts at Deutsche Bank believe the biggest concern over lower interest rates has largely faded. Instead, attention is shifting toward loan growth and the pace of the broader economic recovery. Taken together, these themes suggest that while Europe's banking sector is in a much stronger position than it was just a few years ago, investors are now looking for evidence that this recovery can continue over the long term. As Europe's biggest banks begin reporting their second quarter results, investors will be looking beyond a single set of earnings. The bigger question is whether the sector's recovery can continue in the face of changing economic conditions. Over the past 2 years, higher interest rates have significantly improved bank profitability. Stronger lending margins, healthy loan growth, stable credit quality, and improving operational efficiency have helped transform European banks into one of the region's best-performing sectors. Now investors want to know what comes next. Can banks maintain this momentum if interest rates begin to decline? Will trading and investment banking remain strong enough to offset any slowdown in lending? And can Europe's largest lenders continue narrowing the competitive gap with their U.S. counterparts? Another development worth watching is the European Commission's recent proposal to make cross-border banking mergers easier by reducing political barriers within the European Union. Supporters believe larger, more integrated banks could become more competitive globally and better equipped to finance businesses across Europe. If those reforms move forward, they could reshape the banking landscape over the coming years. At the same time, risks remain. Economic growth across Europe has been uneven, and any deterioration in business activity or consumer confidence could eventually reduce borrowing and increase pressure on bank earnings. Investors will also continue watching for any signs that loan defaults are beginning to rise, even though credit quality has remained relatively stable so far. Ultimately, this earnings season isn't just about how much money banks made over the last 3 months. It's about what those results reveal regarding the strength of Europe's financial system and the direction of its economy. The outlook for European banks remains broadly positive, Analysts expect another quarter of solid profits, supported by continued loan growth, resilient lending margins, stronger trading activity, and improving investment banking performance. However, the market's attention will quickly shift from the headline numbers to management guidance. Investors will be looking for clues about future loan demand, interest rates, credit quality, and the broader economic outlook. These earnings reports from UniCredit, Santander, BNP Paribas, Barclays, Deutsche Bank, UBS, and BBVA will provide valuable insight into whether Europe's banking recovery still has room to run, or whether new economic and geopolitical challenges are beginning to emerge. The answers could influence not only bank stocks, but also investor confidence across European financial markets. If you found this analysis helpful, be sure to subscribe to Capital Compass Daily for clear, fact-based coverage of the latest developments in global markets, investing, business, and the economy. Thanks for watching. See you in the next video.